We're now moving on to exercise 11-20, overhead application, fixed and variable overhead variances. This question is more difficult than the other questions that I've done, which are more basic. This one, you have to work backwards in order to calculate some of the numbers. Now, they've given us a lot of information, but we're focusing specifically on the required. Compute the variable overhead spending and efficiency variances, label as favorable or unfavorable. Compute the fixed overhead spending and volume variances, label as favorable or unfavorable. So we're going to ignore the information about direct materials and direct labor unless we need it in order to calculate some of these. The first thing I'm going to do is go over to my formulas, and I'm going to copy these formulas so that we have them available. I'm going to put them down here so we have some room. There we go. So now we have those formulas. I've gone through the formulas in a lecture video, so I'm not going to go through them again. We're going to read the question. So we've got this company and they're planning to produce 150,000 metal widgets. Widgets is just a name for small mechanical devices. So I'm going to start with my standards. And I know the standard units to produce. What we're planning is 150,000 units. Each unit requires 2 standard hours of direct labor. I'm going to put that in direct labor. And I want the quantity per unit. And then I want the cost per metric, because it could be hours, it could be, kilograms, it could be grams. I don't know what it is, but it's cost per metric. And then I'm going to do total cost. So it tells me they require 2 standard hours, so the quantity is 2, and that the standard direct labor rate is $14 per hour. So the total cost can be calculated. There we go, $28. Now, I know I said I was going to ignore that, but I'm going to put it down because I might need it. Then it says the standard 2.5 grams of direct materials. So we've got direct materials. And this one we're not going to need, but I'm putting it down anyway. 2.25, and this is grams. So let's just put that in here that it's grams. And the cost is $5. And so we can do that calculation by just pulling this up. There we go. It now tells me that the company uses direct labor hours to assign overhead to its products. So we know that when we're looking down here, with regards to the calculation of the application rate, they're going to use, as the total cost driver, they're going to use direct labor hours, standard direct labor hours to calculate the standard application rate. And here, same thing for the variable. The total overhead budget for the coming year is $1.2 million. Total overhead budget, which means this is variable plus the fixed. The standard fixed overhead rate is $3.50 per unit. When they're saying the standard overhead rate is per unit, that means they're telling me the number here. So this is the fixed overhead. They're telling me per unit it's $3.50. I know for the fixed overhead that they're using direct labor hours in order to calculate the application rate. That means that I'm going to use the same standard as the direct labor, 2 hours. So now I know that fixed overhead is 2 hours, that's the driver, and it's $3.50 per unit, so I could calculate the application rate per direct labor hour. So the application rate per direct labor hour is $3.50 divided by the 2 hours. The application rate is $1.75 per hour. So now I need the variable overhead. I know it's going to be 2 hours because they tell me that the company uses direct labor hours. So it's going to be 2. But I need the application rate, and I don't have it. So I'm going to have to use the calculation. I'm going to copy it up here. I need total variable overhead, but I only have variable and fixed. So I have to deduct the fixed overhead total. So what is the fixed overhead total? Well, I know that it's $3.50 per unit, and I know that it's 150,000 units budgeted. So it's going to be 525,000. I could calculate it another way also. I could take the $1.75 application rate, multiply it by the 2, and then multiply it by the 150,000 units, 525. So now that allows me to calculate what is the variable overhead budgeted, 675,000. So that's the variable overhead total for the standard, the budget. So that means I can take the 675 and I can divide it by the total cost driver. We know that the total cost driver is direct labor hours, the total budgeted direct labor hours, which is 2 hours multiplied by the 150,000 budgeted, so that's 300,000 hours. I can now calculate the application rate as $2.25 per direct labor hour. I can put it in here, and I can calculate the total, multiply 2 by 225, and the total standard cost per unit is $47.25. Awesome. So now I need the actual. In this case, I only need the actual for the fixed overhead and the variable overhead. I don't need anything else. Now, I would like to have the quantity, the cost per matrix, and the total cost per unit. And I'm going to take the total cost. In this case, this is total cost per unit. Over here, I'm just going to do the total cost for all of the fixed overhead and all of variable overhead. So I'm going over here and I see the actual results for the year. Production is 142. Well, I need production, so let's just put that actual production. 142,000. There we go. Then it gives me actual direct labor hours, 270,000 actual direct labor hours. I'm not sure that I need that. I actually do, but I'm going to leave it aside for right now. Direct materials, direct materials, direct materials, don't care. Direct materials, don't care. Direct labor costs, don't care. Actual variable overhead in total was 621,000. Actual fixed overhead was 490,000. I want to calculate what quantity of hours per unit were actually used. Well, I can actually do that because I happen to know the actual direct labor hours. They were 270,000 actual direct labor hours. So if there was 270,000 actual direct labor hours, if I divide it by the number of units, I can tell how many direct labor hours was needed for one unit, and that was 1.901408. I'm going to leave it at that. That's direct labor hours. Now, I want the application rate. We know how to calculate this. Go down here. It's the total fixed overhead, actual cost, divided by the total cost driver, which is direct labor hours. We're going to take the total fixed overhead. We're going to divide it by the total direct labor hours, which we already know, 270,000. So the actual application rate is 1.81 with a bunch of decimal places. So the total cost per unit, multiply the direct labor hour quantity by the application rate, is going to be $3.45. Do the same thing here. Variable overhead, hours, is going to be identical to the fixed. I'm going to calculate it in the exact same way, so no need to recalculate it. I know how I'm going to calculate this. Total variable overhead dollars divided by total cost driver, all actual, 621,000 divided by 270,000 direct labor hours, actual, is equal to $2.30. There we go. And the total is going to be $4.37. We now have all the standards and all the actuals. We can do our calculations. Going down here, this is actual production, actual driver per unit, actual variable application rate. I don't have to calculate this. This is given to me as one number. So I'm going to simply take the $621,000 actual spend. Over here, I need actual production. We know what that is. Actual production is 142,000. We're going to multiply it by the actual driver per unit. We know the actual driver per unit. It's right here, the quantity, 1.90. I'm going to leave all the decimal places on. And now I've got to multiply it by the standard application rate. Standard application rate for variable is $2.25. So now I can do the multiplication. This is equal to $607,500. Let's take the difference. Large number, subtract the small number. Awesome, $13,500. Is it good for the company, favorable, or bad for the company, unfavorable? We spent this. We should have only spent this. This sucks. It's unfavorable. Now, note that some textbooks use U without the F. I just use UF. So we know that this is an unfavorable spending variance. We spent too much. Let's look at the efficiency variance. How efficiently did we use the variable overhead resources in order to produce the quantity we produced? So this is actual production. We can take it right from here. We're going to multiply it by the standard driver per unit. Standard driver per unit, 2. Direct labor hours. We're going to multiply that by the standard application rate. We can just steal it from over here. And I just want to be clear. This is direct labor hours, and this is the application rate. So it's dollars. This is, again, direct labor hours, and this is the application rate. So we're going to do the same multiplication. I'm just going to copy this. 639,000. Going to take the difference, larger number, subtract the smaller number. This is 31,500. Is this favorable or unfavorable? Well, the only thing that changed is the item with the squiggle. Nothing else changed. So the actual driver compared to the standard driver per unit. The actual driver per unit was 1.9 hours, and the standard was 2. We were supposed to use 2 hours, and we only used 1.9. Yay for us. This is awesome for the company. This is favorable. Now, if I wanted the total variable overhead variance, if they are both favorable, I add them. If they are both unfavorable, I add them. But if they are the opposite, I take the larger number and I subtract the smaller number. This is 18,000, and of course, favorable was larger, so this is 18,000 favorable. That's how to calculate the variable overhead variances. Notice that if you don't know this, it's going to be hard to remember. But if you memorized only this, and then you changed the bottom item, and then you changed the middle item, you would only have to memorize this part, and then remember that you got to change first the bottom item to standard, and then the middle item to standard, and carry the other two over. So there is easier ways to memorize this. You don't have to memorize the whole chart. You really only have to memorize this first part, and then remember how to change it. All right, let's just go down, and we'll do the fixed overhead variance. Actual production, actual driver per unit, actual fixed application rate. Again, they're giving us this. We just have to grab it. So this is 490,000. Over here, this is the master or static budget. This is all budget information. So I want the standard production, 150,000 units. I want to multiply that by the standard driver per unit, 2, direct labor hours. I want to multiply that by the standard application rate, $1.75. Doing the multiplication, this is $525,000. Awesome. What's the difference between these two? Larger minus the smaller. Perfect, 35,000. I spent this, and I was supposed to spend that. Did I do a good job? Favorable, or a bad job? Unfavorable. I did an awesome job. This is favorable. I spent less money. It's good for the company. Perfect. Now we're going to go over here. Only one thing changes here. I want actual production, 142,000. I'm going to multiply it by the standard. I can steal it. Remember, This is direct labor hours. And this is the application rate standard. Same here. Multiply this by the standard fixed application rate, steal it from over here. And now I'm going to copy my calculation, do exactly the same thing, $497,000. So I'm going to take the difference between these two. Large number, subtract the smaller number. Now, the only thing that changed is the number of units. We should have produced 150 using the machinery and factory and all the other resources that are fixed. We should have made 150,000 units, and we only made 142,000. Were we efficient? Did we efficiently use all of our equipment, all of our resources? No, we did a terrible job. We produced less. That means that we wasted some of our resources. This is totally unfavorable. So remember, this has to be looked at carefully when you're talking about the production volume. Production volume should be at the master budget point. If it's below, we did not utilize our assets appropriately. If it's above, we overutilized our assets. Oh my goodness, that's awesome. Difference is, of course, going to be the total fixed overhead variance. Now, remember, I take the larger and subtract the smaller. And the larger one, favorable. So this is overall favorable. We spent less, and that managed to overcome the fact that we produced less and wasted some of our resources. So we have an overall favorable variance here of 7,000, and we have an overall favorable variance here of 18,000. That's it for exercise 11-20, fixed and variable overhead variances. Notice that there was an additional complication here because we had to actually calculate how much of the total overhead budget related to the variable overhead, and then we had to use that information to calculate the variable application rate. We also had to work backwards to calculate some of the cost per matrix. Keep that in mind when you're looking at more complex questions about fixed and variable overhead variances.